Hello and welcome to episode 466 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'll say okay, which is probably less enthusiastic than I normally am on the podcast, and that's because I've managed to put my back out again, and in keeping with the ridiculous ways in which I managed to put my back out, I managed to do it sitting in a pub. So I was sitting on an uncomfortable bench for too long, turned in a slightly awkward way, talking to someone on my left, and it seized up. It's now loosened up after a week, but yeah, Andy, I think it's age really doing anything. I'm not obviously quite the physical specimen, so that adds to my list of ways of injuring my back in a pub for too long. And the other time I obviously did it when I was trying to put my pants on and I tripped.
The only thing I'm thinking is that with your back and with the football that's coming up over the next week or so, well, maybe that could be the thing that fixes your back. Maybe you did your back in a pub, moving in a slightly innocuous way. Perhaps if England managed somehow, obviously this podcast goes out on the Sunday, we've got the game still to come. Perhaps jumping off the sofa in celebration could fix the back situation.
Perhaps it could, or I could get stuck. The only thing that is a positive, I have to add, before people think, well, that serves them right for sitting in a pub. I was actually in the midst of a meeting with our developers who do a lot of the tech stuff in the background, which people who listen to the show and use the site won't even be aware of that goes on. But there is an exciting project that we are working on. So I can't say any more than that at the moment, but it is something that I think is going to be absolutely amazing. So more of that, or more on that, I should say, later in the summer.
So that is exciting news still to come from Money to the Masses. So let's move on to this week's podcast then. What have we got coming up on this week's show?
So 3 pieces. The first piece is an investing piece. So I'm going to be talking about Nvidia. So Nvidia is the chip maker whose chips are used by companies who are exploring or developing AI. And if you have been reading the news and you're into investing, you probably have noticed that its share price has rocketed over the last 18 months, and to an extent that words like bubble are being used. Now, I carried out a piece of 80/20 investor research, and it was about how you can manage your exposure to Nvidia. So that will be interesting to anybody who is investing, even if you are a passive investor, because it's having a bigger and bigger impact on your portfolio performance. I'm also going to be talking about debt to income ratios. It's something we've not actually talked about on the podcast before, and it's somewhat to my surprise. This is in relation to mortgage applications. And don't worry if you're not applying for a mortgage. It is something that you should be aware of anyway, even if you're not going to apply for a mortgage anytime soon. And the final piece of the show, Andy's going to be talking about a topic we've not covered for a very long time, and it's later life care.
Yeah, so it's going to be a piece really looking all around what is later life care, how likely it is that you'll need it, the cost of later life care, because the costs have rocketed. There's been some research to show just how much it may end up costing you in later life. We'll be looking at who needs to pay for it, because there is certain government help that you can get as well. But crucially, we'll be looking at how you can fund it and if there's any insurance products that may be able to help bridge that gap.
So in this section, I'm going to be talking about Nvidia and managing your exposure to this particular stock. Now, Nvidia is the chip maker that you may have heard of, whose chips are used in the development and obviously the execution of AI products. So with the expansion of AI and the revolution that it seems to be, because let's be honest, this is something that is being likened to the birth of the internet or any other revolution that we've had in the past. And the possibilities of AI and its uses are obviously exciting everybody. And Nvidia is a chip maker that has about an 80% share of the market in terms of AI chips. And of course, what that means is that we've seen its share price explode since we had ChatGPT come into the world, which was roughly around November 2022. So Nvidia's share price has risen almost sevenfold, and in 2024 alone, we've seen its share price rise about 160%. Now, in recent weeks, we've had a bit of a dip. We've seen it pull back about 15%. It's still around about 10% down because we had a little bit of a recovery. And this is where it started to make people nervous, because there was talk of a AI bubble. Now, there really are two kinds of bubbles when you think about stock markets. Now, there's the kind of bubble where people are just really enthused about an investment. And so there typically are a number of stages to that kind of bubble. And there's a famous chart, which we'll put on screen for people who are watching the video version of this podcast. And that the various stages tend to be that people eventually or initially start to become enthused by a particular company or stock, and then it starts to gain media attention. Now, this might sound very familiar when it comes to AI. Then people start becoming very enthusiastic about it, and then the greed sets in and people start piling into that particular stock, and then there's this new paradigm that's supposedly unfolding, and so we see this exponential growth in the particular stock. Then we tend to get a bit of a pullback. Everyone then is in sort of denial. They get a bit of a return to a new normal where they say, actually, that was just a natural pullback. And then we get a capitulation where it tends to implode. And in doing so, people lose lots of money. And there's been some very famous historical cases. Now, I'm not saying Nvidia is in that, but there is another type of bubble which tends to form around new technologies. And there's a good example if you go back to the late 1990s. And that was obviously when the world was gripped by enthusiasm around the internet. And so Cisco Systems, which many people will know and heard of, is a company back then that was being bought aggressively. Investors were piling in because they were excited about the prospect for internet traffic, and therefore they were enthused about the development of telecommunication networks. And Cisco Systems' share price exploded higher, and in a strange echo of what's going on today, it actually overtook Microsoft in terms of its size, which is something that Nvidia has done in recent weeks. But then the emergence or the prediction of what would happen in the future in regards to the adoption of the internet and the potential benefits, etc., took a while to actually come to fruition, and it wasn't as people had expected. And so what happened is the stock price collapsed, and in fact we're now more than 2 decades on, and the share price for Cisco Systems still has not exceeded where it got to that 20 odd years ago. So there are people drawing parallels with Nvidia today, because obviously we've got all the enthusiasm about AI. Nvidia is obviously a big AI play, so people who are piling into that and other chip makers. And so people are saying, well, it might not necessarily be a bubble in terms of the stock itself, but maybe it is in terms of the adoption of AI, and it actually might not be, or the benefits might not be felt in a way that people are predicting, or the adoption, or businesses might not just take it up and use AI in the way that people are predicting. And if that's the case, then obviously Nvidia's share price could come under threat. So the reason I'm talking about it on the podcast is because if you look at the S&P 500, which is a market cap weighted index, so that means the bigger companies make up a bigger proportion of the index. Now, Nvidia has risen so aggressively that it now accounts for about 7% of the S&P 500. So if you are a passive investor and you happen to be investing in a S&P 500 ETF, then you are going to be exposed to Nvidia. Around about 7% of the money you've got invested in an S&P 500 ETF will be exposed to Nvidia and its fortunes. So obviously, if it keeps going higher, as some analysts predict it will do, then you will benefit. But if it implodes and collapses, then that will have an impact on your portfolio. So as a passive investor, you are kind of going along with the ride, or for a ride with Nvidia. If you are invested in the MSCI All Country World Index, then Nvidia accounts for about 3.8% of the assets of that particular index. So the biggest lesson for people out there listening to this podcast is that even if they don't think they're backing Nvidia, they are to an increasing extent. So that obviously gives an opportunity to investors. You may, for example, be really backing the AI theme and think that Nvidia is going to keep pushing higher, then you might decide that you want to gain more exposure to Nvidia, and you don't want to just invest in the stock directly because of the risks associated with maybe putting all of your eggs into one basket, or quite a few of your eggs into one basket. So you might decide you want to invest in a diversified portfolio or a fund, and you want to just have a bit more exposure than is the norm. Now, to give you an idea, if you look at the typical global equity unit trust, then that has around about 4.2% exposure to Nvidia, if it has any exposure at all. There are some that don't, but if it does have exposure, then it typically is about 4.2%. And if you look at a North American equity fund, then we're talking about unit trusts here, then that has an exposure around about 6%. So that's an average. So there are obviously funds that have a much greater exposure and some that have a much lower exposure to Nvidia. So we're at the stage now that people might want to start to take a more of an active role and manage their exposure to this AI theme, and in particular Nvidia. It's an unusual world where we're in, where we have what was at one point 2 weeks ago the largest listed public company in the world acting almost like a kind of meme stock and rallying so much. But of course the risks are increasing to your portfolio. But if you'd been invested in Nvidia in the last, say, 6 months, then you've benefited handsomely. If you hadn't been invested in Nvidia in any way, then your portfolio would be probably lagging the wider market and any other benchmarks that you care to look at. So with 80/20 Investor, I started to look at, are there ways you can increase your exposure? Are there funds you could invest in? Now, I'm not going to go through the different types of funds out there and their particular or individual exposure to Nvidia, but just to give some takeaways for people who are listening to this podcast. Now, there are a range of North American equity funds that do have more than, say, 6% exposure to Nvidia. And I've used the 7% level because that's what the S&P 500 has. Anything above that means you're really taking on an overweight position in Nvidia. And there's a number of funds that do that. Mostly the active funds have something between about 5 to 7% exposure to Nvidia if they are North American funds. But of course, global equity funds have a little bit less. But you can go and take out a free trial and look at the research. But I've given you those benchmarks there, so you can go away and think, I want to get more exposure to Nvidia or I want to get less. Those are the benchmarks. That's typical of what the exposure is. I can either go for more or less when I'm looking at the fund fact sheets. Now, the other thing I want people to bear in mind is, of course, you could go invest in a technology fund, and there are a number of them out there that some of them have as much as nearly 14% exposure to Nvidia, but that obviously increases your risks. Now, there are rare occurrences, but there are some global equity funds that do have up to 14% exposure to Nvidia. So the message is just be mindful of what you're investing in and look under the hood. But there is an interesting takeaway that I just want to add at the end, because like I say, I can't give all the numbers away and all the funds to invest in. I don't want to be making a recommendation of any kind. But you can go and look at the research if you take out a free trial. But investment trusts, they do offer exposure to Nvidia. So a bit like unit trust, there are some out there that invest in global equities that do give exposure to Nvidia. But there is this interesting angle with investment trusts, because they can trade at a premium or a discount. If you find an investment trust that is trading at a discount that has a significant exposure to Nvidia, theoretically, you could gain exposure to Nvidia at a discount. Now, investment trusts can trade at a discount for various different reasons. It can be because of the people who have lost confidence in the manager. But when we talk about trading at a discount, what we mean is the share price of the investment trust, when you work out the market cap, it's actually less than the holdings within the investment trust itself. There is one investment trust out there that is called the M&L Capital Management Limited Manchester and London Investment Trust. This isn't a recommendation, but just an observation that it's trading at a 15% discount to NAV, and it has almost a third of its assets invested in Nvidia. So the problem is, investment trusts, if you buy them, they could continue to trade at a discount, and actually that discount widens. So if you buy the investment trust, you come to sell your shares, you could actually end up making a loss because of the widening of that discount. But it does raise an interesting question of whether you can actually gain exposure to stocks that have risen aggressively via some investment trusts that are trading at a discount. So the takeaway for people listening to this part of the podcast is, go and have a look at your portfolio and see how much exposure that you really do have to the AI theme and a company like Nvidia. And then when you go to invest in other funds, whether it's unit trusts, investment trusts, or ETFs, do look at the exposure it does have to companies like Nvidia, because you may pick a fund that is a North American equity fund and it's done particularly well, but it could be because it has a high exposure to Nvidia, greater than the average of its peers, and therefore by investing in it you are starting to increase your exposure to the fortunes of one particular company, which at the moment has been diverging in terms of correlation from the wider market. It seems to be doing its own thing, and some people are saying that that's a positive, but also that could be another sign that the AI theme is in a bubble.
Okay, so moving on to the next piece of the podcast then. We're going to be talking about debt to income ratio. What have we got then?
So this is something that we've not really talked about in the past in any great detail, and it was something that I thought would be useful on the pod because it gives people a framework to work around when they're trying to control the amount of debt that they're repaying. And so it has a particular relevance to people who are trying to take out a mortgage or want to take out a mortgage. But I also think that it is a useful guide for people who are not even applying for a mortgage, and just how much of their income should be going towards repaying debts. Now, we have heard about credit utilization. It's a topic we've talked about in the past. So just to give people a reminder, this is different. So credit utilization is something where you look at the available credit you have via things that are very flexible. So we're talking about things like credit cards, where people may have balances that go up and down, but they have an available credit limit that is obviously higher. Now, that credit utilization, how much or percentage of the available credit you have that you are using, that ratio is key in determining things like credit scoring, particularly with the main credit rating agencies. So the rule of thumb is, generally speaking, something like 25% to 30% credit utilization is good. So if you are trying to apply for a mortgage, then that's obviously a good ratio to aim for, but it is generally even when you're not applying for a mortgage, because obviously that will be good for any credit scoring. Now, debt to income ratio is something that's different, but it's particularly relevant to mortgage applications. And the DTI ratio is a measure that compares your monthly debt payments to your monthly gross income. So the key thing is gross income. And lenders use it to assess a borrower's ability to manage monthly payments and repay debt. So it falls into that affordability assessment. And what they will do is they will look at your DTI and determine whether they want to lend to you, but it will also potentially influence the interest rate that you could get. Now, there are different types of debt to income ratios. You may hear something called a front end one, which looks at your housing related debt, so particularly your mortgage payments, but there is a back end version which includes all of your debt obligations as well. So that would include all of your debts, credit cards, etc. Now, to give an example of how a debt to income ratio is calculated, they would look at your total debt repayments in a month. So let's say credit cards. Sometimes they actually multiply the amount you pay on a credit card by a factor, let's say 1.5, because if you were paying £500 a month on credit card repayments, then obviously that can generally go up and down because there's an element of flexibility in that. So they might multiply it by 1.5 in that example to get £750. That number is added to all your other payments. If you've got loans, for example, your mortgage payment or your potential mortgage payment if you're a renter, and then that number, that amount, is divided by your monthly gross income, and it's times by 100 to give you that ratio. So if that total was £1,500 a month that you were paying towards your debts and your gross monthly income was £4,000, then your debt to income ratio would be about 37.5%. So what lenders will do is they will take that information and they will decide A, if they want to lend to you, but B, influence the rate of interest that you'll get on any mortgage loan. Now, I've looked around to try and get a steer of what is a good debt to income ratio, and it's quite difficult, but these are some broad figures that if you have something that is over 50%, then you are moving into the high risk borrower territory. So 50 to say 75% is a high risk borrower. 75% and higher, these are very high risk borrowers, and you're likely only going to be able to get a mortgage from some specialist lenders, and it will obviously impact the rate that you will get. You won't necessarily get the best rate at all in the marketplace. If you've got less than 50%, say you've got something like 30 to 50%, then that is going to be an acceptable to moderate risk for the lenders. And so most specialist lenders will offer you a mortgage, and you should get things near standard terms. If you've got less than 30% debt to income ratio, then you are deemed a good borrower, and you're likely to get approved a mortgage by most lenders, not just specialist ones. And you should get, depending on your obviously wider application, some of the better rates out there. So the message for this part of the podcast is, do work out what your debt to income ratio is, because it's a useful figure to know. And even if you're not applying for a mortgage, then you can have a steer of trying to keep it down towards 30%. Then that is a good measure, because I do think it's important to not just do these things when you go to apply for a mortgage. You should do them in the lead up, and preferably try and live your life in a way that you are keeping within these frameworks. So whether it's a debt to income ratio, the credit utilization, because it makes your life easier, and you never quite know when you might have to apply for credit anyway. I'm talking about not necessarily a mortgage, but you might have to move house, for example, suddenly, and have to apply for a mortgage. But I do think the Ricky Hatton version of finance, where you just binge and then have to try and scale back ahead of a mortgage application, is something that's very tricky to do and is likely to, on occasion, lead to problems. So I'm more of a fan of trying to stay in financial shape for the long term and consistently, because it makes your finances more flexible. So that's the debt to income ratio. It does then raise the question of, can you improve it? Well, yes, you can. You could earn more, for starters, or you could start to pay down some of your debt. And with the information that I've given in this part of the podcast, you can see, therefore, that there are arguments in certain instances to try and pay down debt before you apply for a mortgage. Now, there isn't a universal truth. It's always best to do so, but you can see, based upon your own circumstances, you can try and reduce your debt to income ratio or improve your credit utilization, which would actually therefore improve your chances of gaining the mortgage that you want. Obviously, always go and speak to a mortgage broker. They can help you with all these kind of things and actually point you in the direction of a lender that can lend to you and will actually give you the best rate that you can achieve, because obviously there's more to your mortgage application than just a debt to income ratio and a credit utilization. There are wider circumstances in terms of your finances. So there you go, a job for everybody to go and calculate your debt to income ratio. Look to see if there's ways that you can improve it. And on the message of speaking to a mortgage broker, if you don't have one you can trust, and we'll put links in the notes of the show so you can go and find somebody who you can get in touch with. There's no obligation, of course, on your part. Andy, so we're moving on to the next piece in the podcast.
Yeah, and so we're going to cover a piece on the podcast that is talking about later life care. Now, it's been a while since we've done anything on this in the podcast, and it comes really off the back of some research that was done by Interactive Investor as to how much later life care is costing, specifically how much the cost of later life care has increased in the last few years, mainly due to inflation, and the numbers are pretty scary, to be honest. So what I wanted to do first of all is look at what the chances are that any of us would potentially need some later life care. And so looking at the latest census figures, just over 10% of people that are aged 85 or over currently live in care homes. And if you crunch those numbers further, women are more likely than men to live in care homes. Now, again, that's partly to do with life expectancy. That does skew the numbers slightly. And around about 20% of those aged 90 and older are currently living in a care home. So if you look at that, around 1 in 10 people aged 85 or over, and around about 1 in 5 people aged 90 or over are currently living in care homes. So there are the rough numbers. Once you move into a care home, assuming you're 90 or above, the average life expectancy, this is quite depressing this, but it's worth knowing what these life expectancy numbers are, because then you can work out potentially how long you might need this later life care for. If you're 90 or more, then the average life expectancy for a woman is around about 2.9 years, so just under 3 years of care. And if you're a man, it's less, it's 2.2 years. So we've looked at the potential chances of us needing care in later life and roughly how long we might need, let's now look at how much that care home stay may end up costing us. So looking at today's numbers, people in care today, care home residents are currently paying on average £111,000. However, that is just for the care home stay. That doesn't include additional nursing costs. If you require a stay in a care home with extra nursing costs, that figure rises to £136,000. Now let's look at those numbers in the future. So Interactive Investor did some research, and based on annual inflation averaging around about 2% a year, how much would it cost in 20 years' time? So roughly, if you're in your 60s now and looking at those age expectancy numbers, how much would it cost in your 80s in 20 years' time? Well, that £111,000 goes to up to £165,000. That's just for the stay. And then if we're looking at the extra nursing care costs, if you're someone who requires that extra care, then now you're looking at over £200,000, so £201,000. And that is just for a 2-year stay in a care home. And so those numbers there are pretty eye-watering, to be honest. And even if you don't end up needing later life care, it's worth knowing the rough cost of what care in your home would cost, because there are lots and lots of people who aren't in care homes who still require people to come around and help out. Now, the average cost at the moment is around about £25 per hour. Of course, when you extrapolate that up with inflation, that's going to be much more in the future. So just bear that in mind. £25 an hour is the average cost of getting someone else in to help you out at home. So let's quickly look then on who needs to pay for later life care, because not everyone does. So if your local council carries out a care assessment and decides that you need a spot in a care home, then they'll end up doing what's called a means tested financial assessment to figure out how much help that they could offer you, if any. Now, current rules mean that if you typically have more than around about £23,000, it's £23,250 exactly in savings, that's referred to as the upper capital limit, and you'll not be offered any funding towards your care, and you'll be expected to pay your own fees in full. If you have less than £23,000 in savings, then your contribution will depend on exactly how much you do have, and anyone with savings less than £14,250 will mean that the council will cover your care in full if you need it. And so I just wanted to cover off quickly, if you're someone who owns your own home and you require later life care, you may be expected to sell that house in order to fund those costs. That doesn't typically apply if you just need help at home, obviously. And if there is someone already living in your house with you, or you've got a partner there, then again, typically you won't be expected to sell that to fund your care home costs. I wanted to then cover off quickly some rules that are expected to come in place in October 2025. I'm not going to go into a lot of detail, and the reason for that is these changes were expected to first come into place in October 2023, and they were then pushed back. They're still subject to parliamentary approval, and again, we've got a new government, so there is still a lot of uncertainty as to whether these dates will be met and indeed whether these changes become enshrined fully in law. Quickly covering off what these changes mean, though, it is good news for people funding later life care. There's going to be an upper cap on how much you'll be expected to pay, so it's due to be set at £86,000, so you won't need to ever pay any more than that. It will be then funded by the government over and above that level. And there's also some interesting tweaks to that £23,000 savings limit, which we talked about earlier, that you need to have at least those savings. We put it in the details in the show notes. You can read those in detail. Just be mindful, Damien, that those rules with a new government, it's not necessarily going to be top of their priority.
Okay, so there are a lot of people who probably are thinking about later life care at some point, how they might be able to fund it. So there are a number of options open to them.
Yeah, and so one of the simplest options, Damien, is to actually save for it. So Interactive Investor, as part of their research piece, did a bit of research on what a 65-year-old today would need to in order to fund that care. And they say that around about £500 a month over the next 20 years, assuming that annual investment growth of around 5%, would give a 65-year-old today £200,000 in 20 years' time. So by the time they hit their mid-80s, they would be able to effectively afford that £200,000 later life care that we talked about earlier in the podcast. Now, these savings are on top of any pension pot you'd require to initially retire in the first place. So this is separate to that. Obviously, the younger you start, the less you need to save. So we had a little look on what that would be. If that 65-year-old started saving at 60, so effectively they would save for an extra 5 years, it would come down from £500 a month. Again, assuming a growth of 5%, they'd need to save £350 a month. But of course, bear in mind, they're saving for that extra 5 years. We then worked it back, Damien, to what you and I would effectively need to save in order to fund our later life care. So we're looking at roughly a 45-year-old, how much it would cost them, and it's about £180 a month. So again, that comes down significantly, but just bear in mind you'd be saving a lot longer. So it is something that you could consider. Have a play around with the figures yourself if you like. We've actually got an investment calculator on the Money to the Masses website. We'll put a link to that in the show notes, and you can play about with those sliders and ages, and you can see roughly how much you might need to save in order to fund your later life care. Again, using those £200,000. I think £200,000 is a good figure to start with. It's scary numbers, I know. Damien, just before we finish, I wanted to cover off one other way that you could do it. There are insurance products out there, and I've picked one in particular from an insurer we've talked about before on the podcast, Vitality. Now, they have an option within their serious illness cover where you can extend the plan to cover later life conditions such as dementia, Alzheimer's, Parkinson's, and there's an additional cover for something called frailty. You have to meet certain conditions in order to get a payout on that. Now, the plan is fairly straightforward in that if you're diagnosed with one of the conditions on that plan, you will receive a lump sum up to £100,000. And because that insurance plan is severity based, it does mean that you could get an initial payout which could pay for some of your care costs, and if the condition worsens, you could be entitled to further payments down the line. So yeah, it is something to consider, Damien. It's not the cheapest of plans. A serious illness cover, it's effectively like a critical illness cover. We've covered critical illness on the podcast before. It is something that isn't a few pounds a month. You're talking about 40, 50, 60, if not more pounds a month, but it is something you could consider to extend into your later life that could help cover towards that later life care.
Yeah, and I think it's quite interesting because I do think this is going to be a market that's going to expand into the future as people want to take out insurances to be able to pay for later life care. So it's something that we will inevitably come back to on the podcast as that market starts to develop. And as you say, Andy, what we've been talking about, or you've been talking about on the show today, is going to be subject to some kind of change when it comes to policies about who has to pay and how much they have to pay, especially as we have now got a new government. But the fact still remains that the cost is very high, and if you do want to fund it, then you have to start to plan far earlier if you want it to be a little bit more affordable. So Andy, I think that is it for this week on the podcast. As ever, please do leave us a 5-star review on whichever app you use to listen to the show. Do go to the YouTube channel, subscribe to our channel, but also do leave comments and any questions that you have got, and please do make sure you interact with us over there. And it is the best place, actually. I'm always responding to questions over on the YouTube channel, and also don't forget to follow us on TikTok and Instagram, but also join our Facebook group. It's very active, facebook.com/groups/Money to the Masses. And the final thing I would say is go to the Money to the Masses website, moneytothemasses.com/podcast, where you can find the page with all the offers for listeners, but also ways that you can support the show, but that will almost inevitably save you money as well. So Andy, I think that is everything. So all that's left to say is until next time.
Until next time.